Hey guys, Mike here. So obviously super green day to day after CPI data came out better than expected, which is a good thing. And what I tell you, I'm saying I'm right because I told you yesterday when Upstart had disastrous earnings and was down, Roblox is down. I said in this market, don't be surprised if they're up big time. And what happened? You got Upstart, disastrous earnings, no problem, up 17% today. It's almost fully recovered, right? Roblox, disastrous, missed by 1 million users. Earnings are down quarter over quarter, no problem. It went from 15% down to green today, for God's sakes. Coinbase, $1 billion loss, nowhere near the amount of assets people thought they had on the books. All this crazy stuff, and they're up 7% today. Trade Desk actually had great earnings, up their forecast, very surprising, and they're up 34%. At least they had good, solid earnings. And this is one of those things I tell people. You got companies that are reporting good earnings, companies reporting really bad earnings, but it doesn't matter because whatever the saying is, one tide and lifts all boats or whatever. Well, that's what's happening. Everything's just going up. You know, the only thing I saw red today was literally trash stocks. And I mean literally like the companies that pick your trash up at the curb, Waste Management, they were red today. I think Walmart may have been red too, but you know, anything especially to do with risk, boom, crypto, didn't matter, everything's green. And so big move up. Again, I'll go ahead and say, because I can show you the chart, but the QQQ is literally just sitting right there, once again bouncing off that downward descending channel it's been in. So we'll see if tomorrow maybe it breaks above that. But you know, when it came out, I mean, this is the favorite memes today, right? Everybody's like, oh yeah, and thank God, because I actually did buy some call options on the QQQ once I saw the White House didn't report. And so that turned out well. It was a good morning in the Jones household. And then, of course, here's short sellers, man. They got absolutely hammered, and they just been getting hammered for a month now. And maybe they're starting to give in. We'll see. But you know, going into CPI right now, finally, there it is. Right there on the bottom, you can barely make it out. But we actually decrease instead of increasing for the first time since, well, I don't even know when at this point in time. I think it's been a year and 9 months or something. But then, of course, here you are with core. This is the key, right? So core is still sitting, it's still high. This is the sticky stuff, the rents and stuff. This is the thing that's going to be really tough to get down, and what the Fed absolutely is concentrated on, not the headline CPI, but it is down, which is a good thing. And then consumer price inflation, as you can see right here, this is the services and goods. We're 70% services in our economy. This is what you want to pay attention to. Big drop off, and so this is what we want to see, especially on the services side, to be honest with you, since that's the majority of our economy right now, because it was trending up, as you can see. And to give you another visual, just for the heck of it, you can see right there, boom, it was like 0.02 or something was the official number, but obviously that's a big difference in what I've been showing you guys. And by the way, if you get anything out of this, please hit that like and subscribe button for me. I really appreciate it. Think about sharing the video. As always, guys, thank you for all your support. And just highlighting a couple of things. We won't go through and bore you with it, but look at this right here. Still increases, right, in food. I mean, food is still a problem, but the big thing was the energy. Look at this drop off. This offset, I mean, pretty much any increases right here. Huge drop off. Gasoline is right around like $4.01 today. That's up from 30 days ago. And the big part to really understand is core CPI is the key, right? I mean, that's minus food and energy. But, you know, I think it's like 40% of the CPI is actually housing anyway. And so right now, you know, nobody sees rents coming down anytime soon, okay? And so that's going to be really sticky. There's going to be certain things that are just going to be hard. And you saw how long it took, and still taking, for those prices, that price drop in oil to affect the pumps, right? Oil was down like 38%. We're still only down like 22% in gas, but it took a lot longer to get here. And so, now same thing's going to happen with food. And if oil will continue to drop, even though it seems to be pretty dang respecting that $90 amount right now, because it dropped 88 this morning, went right back up to 92. And so, you know, that's pretty interesting. But we'll see, because obviously we're going to have winter coming along. Who knows what that's going to bring. And so we'll see what happens. Plus you had like, I don't know why airline tickets dropped like 17%. You know, I'm not sure why that is, but hey, you know, we'll take it. Anything we can take at this point in time. But I will say, you know, we'll see what happens next month. We want at least give me 2 months in a row, because we've already seen this headline that, oh, we've peaked in inflation back, I think it was April, I believe it was, and we got tricked. It went down and boom, popped up the next 2 months. And so, let's at least get 2 months in to see what we got going on and just pay attention to the core CPI. And the important part to understand is, why is this so critical? Why is the Fed, hopefully they don't screw up and all of a sudden just start pausing rates and backing out of this. Hopefully, they seem to be, I hope they're going to be smart people. I have no faith in them to do this because we're in an election year. But the reason why it's important for them to stay this course and keep raising those rates like they need to is because they have to get this under control. You can't pull the 1970s where they raise rates, then let off the gas, and then when inflation started coming down, and then it just skyrocketed even higher. All right, it's like a virus. You have to tame it. You have to treat it and everything. And so, understand the reason why they want price stability and wages to actually level out. I.e., to do that has to have unemployment go up, of course, because we have a really hot labor market, right? A really, really hot labor market. And understand this right here. Your purchasing power of $100, that's where it was in 2016. That's where it was in 2020 right there, around 94. Look where it's at now because of what we're going through. So you're not buying as much, right? You know this. But here's the key right here. See that line going across there at the 0%? This right here is when we went on this great bull run. You don't go on great bull runs unless your real wages are actually increasing or at least above that line. Has to be, because we're the consumer, right? We're the one buying everything. We're the one making those earning calls sound so good for all these companies. And you look over to the right there, and this is where we're at right now. And it's just not good. It's still declining at this point in time. We're way down there, farther than we were even in 08, for God's sakes. And so this is why it is absolutely pivotal that they have to squash inflation and get us down to at least 2 to 3%, maybe 4 at least. It's something like that, because it's just, this isn't a good thing. All right, this chart to me just kind of tells everything you need to know about what the Fed's trying to do. And trust me, I love seeing green because I've made purchases along this run up, and I've always been in this market anyway. But understand the Fed, they don't want to see the market run up like this, right? Because when it starts running up and those yields start dropping like that, remember that they were happy because the market was doing their work for them, and the more the market does it for them, the less they have to do, the less hawkish they have to be. All of a sudden now you see yields dropping, and we'll have to watch the bond market closely to see if they're buying into this narrative that the Fed's going to pivot and start lowering rates, because they can come out there and say there's no way they're not, and they'd be a fool to do it before they have inflation under control, right? And so, they may kind of be tamed now before the election, which that's all the way in November, which is kind of right around the corner in a way. But after that, we'll see what they got to say depending on who comes into office. But that, is really the big key. And that's what this, again, you can't tell me this is a fundamental move, because you saw some of these earnings, right? And yet those stocks are up huge. They're telling you what's going to happen for the rest of the year, and it's not going to be good, right? But those stocks are going up. But understand, this is an interesting time, because I was thinking about this last night, and what screws all the data up and everything up is, maybe you can remember a time, if you've been around long enough, to where you actually had 2 crashes. You had one that started back in 2021 in February with all the ARK stocks, all the SPAC stocks. They've all been crashing since February last year. And then all of a sudden, so you got that crash going on, and they're already down over 50% easy by the time 2022 hits. Well, then the SPY rolls over, boom, and then all the big tech stocks, and every tech stock for that matter, starts to roll over, right, and head down south. And so then all of a sudden you got one crash meeting another crash. Now you have them both going down together. And the first crash started, puts those stocks down between 75 and 90%, and the other stocks down between 20 to 40%, somewhere in there. And so you have 2 different stock markets, right? That's why I showed you those charts of all those ARK stocks and SPAC stocks and all that. They started basing out way before any of the rest of them had, because they've been crashing for so long. And one thing people have figured out is, hey, just buy these SPAC stocks that are between $1 and $3. Just hold on to them. They're going to run up, and that's what's happened. You have it doesn't matter what fundamentals are. Some people are just buying and holding for buyouts and all kinds of stuff. You can go on Twitter and see what people are doing, and it's been good to them, right? They've been able to double it. Look at Roblox. Roblox comes out even on the last quarter earnings, and even said month over month revenue's decreasing, users decreasing. Didn't matter. Stock is almost doubled, right, in less than, I think it's 45 days or something like that. Shopify is another one, just got destroyed. I think it's up 70% in the last 45 days. I mean, you got a lot of SPAC stocks you've never even heard of. I've been looking at them; they're up between like 70 to 200%. I mean, it's just mine. Trust me, their fundamentals are no better, right? There's still no profits, taking on massive debt, and that brings me to what I heard yesterday, which made me laugh. I've never heard anybody come on a mainstream financial channel and actually say this right here, but this is two good points she makes, and I'm going to touch base on it.
For sure, I don't want anything that has a lot of leverage. I think that's very underappreciated by the market, is how many of these companies have either variable rate maturities or maturities that are coming due relatively soon, and it's going to be a very different world for them coming back to the capital markets. And similarly, I think most of these tech businesses that are run by young CEOs, they've never been a manager in a recession. They're going to come across a very different world when they can't just get their way out of trouble by buying ping pong tables and beer taps. It's a new world for them.
And I mean, I don't know how you don't laugh at that. I've never heard anybody talk about CEOs like that, but she's right. Have you not noticed how young a lot of the CEOs are? They're extremely young. They've definitely, I mean, a lot of these companies haven't been around for 2 or 3 years, let alone since basically 08 when we had the real recession, right, 15 years ago. And then on top of that, you got a lot of these companies, they were taking on debt at very low interest rates. I mean, we held them for zero for a while there, but even before the crash of 2020, they weren't high. And now all of a sudden, they're going to be coming back trying to refinance debt, take on new debt at these higher rates. And you're like, oh, that's going to be a whole different ballgame, isn't it? Especially if they hold those rates there for a while while they try to tame inflation. So it's going to be a different story. It's no different than I told you, all these hedge fund managers, over half of them at least, if not more, they weren't even around in 08, right? That was a long time ago. I mean, people think it was yesterday, but it was 14 years ago. Most of those guys had never been through a recession, never been through anything like that, never been through anything like this. And so, it's just interesting to see how they're navigating the waters, and it could be why you're seeing the market doing this right here and taking these huge swings up with meme stocks and everything else going up. And so, yeah, it's going to be interesting. That stuff's going to be down the road, obviously. I mean, right now everybody's pretty euphoric and we're going through it, but that's coming, right? And that's what she was saying, a lot of this debt's going to come due soon. People just aren't paying attention to it right now. When it does, they usually like to refi or take out new debt for these high growth stocks. And these are the same companies that are laying off people, by the way, which is not good. And so trying to ratchet down their costs. And so that's going to be fun times. And again, yeah, I mean, there actually is a CEO. I know who she's referencing. I just can't remember his name. That did go out and buy ping pong tables and whatever other things she talked about, bongs and everything else for their people, right? For motivation. I mean, that's what she's talking about and referencing for those who don't know. But I just found it hilarious to hear somebody come out there and you saw the people's faces. The traders were like, oh, okay. Somebody just actually said that. And so, it's going to be fun times. Enjoy the green. We'll see if we can. I think the key is, once you break through on the QQQ, that important level, and then the SPY has its levels it's trying to break through. Once that happens, you had I think it was Trade Desk today reclaiming its 200 moving average on the daily. So, hey, when that starts to happen, that's powerful stuff. It doesn't matter what's going on fundamentally or anything else with the balance sheets and income statements. It just doesn't matter. It doesn't matter. You got so much momentum pushing. And a lot more people will start to flow in and the algorithms really kick in hard then and start putting money in. So we're going to see, if this continues up or not. Because remember, no Fed meeting, no Fed rate hike. I can't think of any data that's coming out in August that could derail this. I don't know. I mean, maybe there is. Let me know what I'm missing. But I don't know. So we're going to see what happens. And I don't expect every day to be like today. That's for dang sure. Because we've moved up a lot. I mean, a lot. And you've been there and you've seen these euphoric moves. What happens usually after that? There is a cooling off period, people taking profits, all that kind of stuff. So, we'll see. Let me know in the comments what you're doing and stuff and what you think about it. And, how long you think the rally can continue or what you thought about CPI data as well. So, anyway, see you guys tomorrow.